So, good afternoon, everybody. We thought with an exquisite gentleman here to put together kind of the panel that for you to remember, and we thought of a topic which would be interesting for us, of course, but which would be key to the success of any startup other than the product and service they are developing. We all have great ideas. Some of us even manage to put that great ideas into actual product and services. But that does not make an entrepreneur successful in terms of startup. So a successful entrepreneur is actually a good storyteller. A good storyteller in the sense that he manages to convince the talent to join the team, and he manages to convince the investors to believe in the story, to join the journey. So today we're tackling that last bit, and we think that it's a key to success of any firm. And we will touch upon fundraising strategies, do's and don'ts in fundraising. We'll also touch upon investor and founder relations. How important is that, and what are the pitfalls there? And in the end, if we have time, we'd like to talk a little bit about governance, board seats, vetoes, how that impact the success of the firm. But first, I would like actually our panelists to give a bit of background and context to where they are coming from. So, Helmer, you are managing one of the largest European venture capital funds, Equity Ventures, but you have a much more diverse background.
Yeah, thank you. Yeah, I'm a 7 times serial entrepreneur in those companies, even 1 or 2 of them starting even before internet existed. I've been around the block for quite a long time and raised money. I've done 6 Series A out of those companies and several Series B and 1 IPO and a couple of trade sales as well. So I've really been on that part, my bigger part of my life, and the last 5 years I decided to switch side and setting up Equity Ventures, which is the venture arm of EQT, which is one of the largest private equity platforms here in Europe, and raised 2 funds there, Equity Venture 1, 566 million euros, and we closed our Equity Venture 2 a couple of months ago, 660 million euros. So we are a multi-stage investor on that side, and we invested in 60 startups to date over the last 3.5 years since we launched the fund officially.
Okay, thank you. Adam, you are part of the largest Swedish law firm.
Nordic Law.
Oh, Nordic Law firm, yes. but you're not Swede.
No, I'm not. So I'm an American guy who has a Swedish wife and ended up in Stockholm in 2002.
Heard that story before.
You've heard the story, yeah. Same old, same old. She said it was a high-income, low-tax country. Then when we got there, she changed her story. I'm the head of our corporate practice. Not much more to say. I'm a lawyer, but I've had the privilege of working with some of Sweden's most fantastic companies.
And then Johan, finally, you are a CFO of one of the best-known Estonian and fastest-growing European startups, Bolt. Can you give your background?
Yeah, I am, I guess. First of all, these chairs are so low, it feels like I'm sitting in a beanbag or something. It's hard to find a good position here. But
like those folks over there.
Yeah, that's actually pretty comfy. Yeah, so I started my career as an entrepreneur myself, but not a very successful one. And I moved then to join TeliaSonera as a telco operator, where I was part of a startup division called New Businesses, where I created the digital home bet, Telia Smart, and then moved over to TradeDoubler, which was Daniel Ek and Martin Laursson's previous company before Spotify. Was there for a while before I took the wise decision to move over to Spotify, where I stayed for more than 6 years. And then, you know, after IPO and everything, it became a very mature company, and it felt like the right time to find the next great scale-up company. And I think really looking through Europe, there were no company that made me more excited than Bolt in that journey, and the potential for Bolt as well. So I guess as a previously failed entrepreneur, I changed my strategy and started to just tag along to successful entrepreneurs and see if I could follow on the ride there. So,
how does it feel to be in Estonian startup scene? Is that different than
so
your previous experience?
I literally know very little about Estonian startup before I joined. More than I know, it's been extremely punching above its weights when it comes to companies. I think we talk about Stockholm being a unicorn factor, we talk about Silicon Valley and so on, and Berlin, but to be honest, as a unicorn factor per capita, I think there's no one beating Estonia or Tallinn specifically, so kudos. Whatever you guys are doing here, it's been working for a long time.
Okay, good to hear. So we have on the stage Helmer, who is a serial entrepreneur, kind of serial founder himself, so he knows the struggles that many of the founders are going through. At the same time, Helmer is also kind of represents the investor view. We have Johan, who is kind of more involved in late-stage venture capital rounds, has the financing of successful startup companies. And Adam, who is kind of with US, Swedish background, you know the troubles that reach to kind of to the lawyers, and you know what is the proper governance and what are the pitfalls there. But let's first go to the fundraising. I would actually first like to ask audience, how many of you have been involved or are currently being involved in fundraising on a company side or investor side? Please raise a hand. Okay. That's not many, but quite a few. How many of you are planning to be involved in fundraising or wish to fundraise sometime in the future? Well, that's more. That's more. So we have the right audience.
Right.
But let's start with the early stage. I assume many of those who are founders in the audience are early stage founders, and I think the first question is that when is the right time to actually start fundraising, when you are still working on your product or new service? So when should a founder start thinking about fundraising? Helmer.
I think it's important based on your idea that you have, and if you're a very ambitious founder and you have a very ambitious idea that could go global, it's all about in the world that we're living today, where when I started my first mobile internet company, we were the mobile internet company in the world. Now we have roughly hundreds of companies attacking the same problem usually worldwide, and it's all about having the steepest trajectory to success early on in your business. And therefore you need to think about funding almost the same day you come up with your idea and starting to decide to actually implement and execute on that idea. And thinking through how to fund it and who you should actually try to get money from, and create a very clear picture on that, not just for the round that you are doing first with a pre-seed round and get some angel capital in, but really thinking through that, the multiple stage going forward, which we're going to discuss about a bit later on. So start day one.
Okay. Johan? Any views?
Yeah, I think the biggest error you can do as a startup entrepreneur is to go out fundraising too late. So rather a little bit too early than a little bit too late, and it gives you a lot of benefits. First of all, you can get some direct, honest feedback from people that have seen hundreds of startups in the past, and they can actually tell you some valid feedback in the way that or the way you're thinking. Is it the right way of attacking this issue, or is there other companies out there that you should be talking to, and so on. So I actually think, to Yama's point, the sooner the better. And I think maybe some entrepreneurs, the mistakes they do is that they say, I don't have a product, I don't have proven product market fit yet, there's too early for me to go out fundraising. And you should be surprised how much you actually can sell a story and an idea, early stage at least, talking about angel, seed investment kind of stage, maybe even Series A, if you're a credible entrepreneur. So yeah, rather sooner than later, and absolutely not too late, because that's what kills businesses, or puts you in a corner where you don't really control the fundraise yourself.
Adam, you probably see also some early stage founders approaching you as a lawyer? Do you see the kind of, is there any steps they should do to kind of, from their own relation point of view that to kind of solve before going that route?
Yeah, I mean, to me, at least looking at it as a consultant, so it's a little bit from the outside, but I think of a couple things. One is it's a relationship between founders and investors. It's not just money. So you need to be thinking about building a kind of a community, a little bit of an ecosystem already early on. Am I going to work well with this person? Are long-term views, or at least medium-term views, aligned? And that really can be very important later on as the company goes through its journey. And I guess my other point would be, don't take the first offer necessarily that comes along, both because you're trying to build a little bit of buzz, but also, and because you're trying to build a little bit of buzz, because frankly you're trying to get a little bit of leverage and choice, so you can get a little bit of balance also with your investor.
Yeah, we'll talk about that buzz a little bit later, about the process, but we actually have the first question from the Slido, so please use that, or just raise your hand. It's a bit more difficult to see you, but the Slido questions definitely reach me. And the question here is that how much a hardware company should raise in an angel round? Is that a philosophical question, or can you answer that?
I think it's like, how long is a piece of rope? It's impossible to answer in a generic way, but I think what's important when you raise money early, and I think being both sides of the table here, both been raising a lot of money in my startups and being an investor, early stage investment is all about the jockey, not the horse, hence not the company per se. You're looking as an investor on the founder market fit. And do you believe this founder has the capabilities to not only raise the money from you, but really actually using that money to hire an amazing team and be able to execute on that story and that vision that that founder has? So you're really zooming in. I would say 90–95% of an early stage investor is the investor gauging you as a founder. And then your ability to actually execute on that founder market fit and the timing of that. So have that in mind in terms of how you sell the story. You are actually being engaged, not really what you, kind of the product per se. Of course, the product has to be an opportunity, the total accessible market has to be big and so forth, and validate that it could be a good investment as well. But per se, the risk is more your ability or the founder team's ability to execute and the timing of what you're going to execute. That's how an investor look at you early stage. That differs later on, and Johan would probably talk about how it looks later.
I would, as an early stage entrepreneur, also think about runway and next milestones. So if you want to raise capital early on, you should think about how much capital do I need to be able to achieve the next milestone, which is a natural place to, okay, I had an idea, I proved it out with the money I raised, it actually works, that's the next milestone to go out and raise more money. So making sure that you have enough runway to reach that milestone is kind of the way to identify how much money do you actually need.
And tagging on what Johan says, I think you have to remember to get someone into your cap table is more difficult to get rid of that investor than your spouse. So having someone in your cap table, that's like a marriage. So don't just go for the highest valuation in the round you're just doing. You need to think through what value add will this investor give to me? What's the relationship I can have with this investor in terms of helping me beyond capital? And this investor's ability to help me get access to other investors later stage. So it's not about optimizing the value on every round, it's optimizing how to succeed going forward if you know you need to raise more money. So always think about your next round, or potentially even in the round after that round, and really foresee how this is going to go forward.
Long-term value instead of short-term.
Yeah. What are the fundraising instruments kind of that startups are using, and when to use what? Johan?
Well, you have SMS loans. Usually not the best approach. No, but I think the earlier stage and the less experienced founder, the simpler you should think about what instruments to choose. Straight equity is probably the most straightforward one and most common one to use, and try to make a straight equity round with as little covenants or restrictions as possible, I think. Someone, usually an angel investor, maybe a former founder themselves, There's a lot of them here in Estonia already, right? That has some spare money to bet on great entrepreneurs with great ideas, and they are usually very flexible on terms and very much more supportive than anything else, right? So I think that's the way to think about it early stage. The more mature you become, the more you build a team, and the more you control your own destiny. That's where you can start fiddling around a little bit with cash efficiency, in the sense of you have the convertible structure. We raised $1 billion ahead of the IPO with Spotify. It was fairly late stage as a company at the time, but we did it because we felt that there were market disruptions. At the time, we wouldn't been able to get the valuations that we wanted in straight equity. Also, we were having like a clear sight to going public. So it was kind of a thing, let's kick the can down the road on valuation. And while doing so, we get some good crossover investors with great names that will be good to have for the IPO roadshow. But we also minimize the dilution impact. But I would say, if you want to go down that path, or even further down that path with a pure loan or even a venture loan, you need to be really sure about your business and you as a founder, as a management team, your ability to hit the targets. Because if you're not hitting the targets, the further down that road you go, especially venture debt, you kind of really locked in and stuck by whoever sits on the debt.
Yeah. Helmer, are there any kind of, from investor point of view, are there any kind of preference in which kind of instrument we use when?
Yeah, I mean, I think when it gets very competitive, one play that a lot of investors doing, that they can agree to higher valuations, but they put in a lot of preference rights into the structure in terms of the terms, which a lot of founders doesn't really understand what it means, and they're of course very bullish on their business, so they don't think it's going to bite them back, because they're going to blow through those preferential rights thresholds anyway. I think that's a very dangerous path to go, because what happens is, when you start doing very dirty term sheets and agreeing to that, and then that turns into a shareholders agreement, you're actually going to give the next round the right to inherit those and put even worse things on top of that. And suddenly you have a slippery slopes of terms around your valuation. And if you hit the speed bump, and I would say if is probably not the right way to say it, when you hit the speed bump, because all startups do, and you hit that in a way where you actually need additional funding, that whole pref stack situation can really, really hurt you back in a way that earlier investors and yourself will be completely wiped out, and so forth. So I think here you have to be careful. Keep it simple, keep it clean, not thinking of optimizing your valuation in this round, and always, of course, fundraise when you have demand, and not when you desperately need the money, because usually you desperately need money when you hit the speed bump, and that's when, of course, the investor gets scared. So I think here we have some.
Yeah, I just want to say also, make sure that you are connected to the market as well. Yeah. A lot of founders, I think, have overconfidence in their product and their numbers, and they start way too late, because how hard can it be to raise money, right? It should just be a few weeks and then we're done. I think no matter what stage you are, it's always at least a 3-month process.
Helmer mentioned about using pref in order to drive the valuation. So, Adam,
yeah, just maybe for some of the folks here who may not have done a lot of fundraising. So, the way a preference investment works is that investor will get paid all of their money back, and then sometimes a guaranteed return before anybody else gets anything. And so clearly, if you're investing on those terms, you're willing to invest at a higher valuation, which means less dilution for the founders, typically early on. It's just a pedagogical point. And we have seen some of the big headline valuations that you see in the newspapers the last 10 years have been driven by very aggressive pref. And I fully agree with both of my companions on the panel here. That can be addictive. So you have to watch out for it. It can be like the heroin of fundraising.
Yeah. And I think another tactic that's very important as a founder, and if you take that role, is build relationships with your potential future investors early. Keep some good news for later. So it's very good to kind of meet investors and then talk about your trajectory and where things are going, and then actually succeed beyond those trajectories. So don't overplay the book in terms of saying that you're going to grow like 300-400% and then you only grow 200%. It's much better to kind of say a slightly lower number and where your trajectory are, and then you actually update them, you know, on a continuously basis with good news that actually put that trajectory slightly higher. Because then, I mean, as an investor, you kind of always have a very high tax on what entrepreneurs say, because they're always, of course, should believe in their businesses, and they're overstating their wishing, more wishes how they would like to grow than actually more realistic. So to build trust with investors and the right investors, meet them early, keep a dialogue, and come in with good news, you know, on the way, and update them with that good news, even if they actually have happened. So sometimes you should even keep something in your back pocket if you're fundraising, and then you tell them something, and they say, oh, and you already have a deal signed or some big event happen, and you can then slip that out like 48 hours later or a week later, even if it was done before. I mean, those small tricks I would recommend you to think about when you're fundraising as well.
There was a good question from the audience. What about crowdfunding? Do you have any opinion about using crowdfunding for your ideas?
Some people say there's wisdom in crowds, and some people say the opposite.
I think it's just when you go that path, it will make it more difficult for you to actually get a value-add investor coming in after that. And the reason why, if you haven't structured it right with an SPV, which is a single-purpose vehicle, you kind of aggregate all those investors in one investor that invests in your company, the cap table will look very, very fragmented. And if you have a very fragmented cap table very early in your company, that scares away later stage investors, because that could have some very big implication in terms of the shareholders has to be informed and veto rights, etc., etc. It comes in a bit more to governance. So keep it clean and simple in your cap table, have a clean and simple shareholders agreement, and don't have too many.
Is there a slight feeling that quality companies don't turn to crowdfunding, to be a bit blunt?
Historically, yes. Will that change over time? Maybe. You know, why should just investors have the monopoly investing into great companies? So I think that might actually change and loosen up over time. But also another thing that you might not think about early on is that as you add on a lot of private individuals, pretty much what it is, and to Hjalmar's point as well, you really need to think through that kind of vehicle that you kind of bundle them into. But even if you do, there is regulatory regimes in the world that says, I don't care about that SPV. I know it contains 2,000 private individuals, and I care about those 2,000 private individuals. Hence, I will look at you as you were a public company because you have so many private individuals on your cap table. Hence, I will put a lot of regulatory demands on you, including reporting and so on. So actually, kind of what happened to Facebook, what expedite their going public, was that they had an SPV that the US government were looking through, as you actually have much more shareholders than you're saying, hence you should be starting to report as a public company.
Yeah. There was also another question, which when we talk a little bit about the process of fundraising, somebody in the audience asked a good question that, have you ever seen advisor killing the deal? Johan, you should be careful not to mention people on stage.
I can start with that from an early stage perspective. If an early stage company comes to EQT Ventures with an advisor fronting the investment, that's a big red flag to start with. I mean, we would literally look at that company very differently versus if we kind of proactively, due to we know that the company has some progress, we are interacting with the founder directly and the team. So be careful with advisors early. I mean, of course, when you come to later stage rounds, when you know, you're raising hundreds, maybe $1 billion, you know, then it's a different story, because then you look at the company very differently. But early stage, please stay away from it. It's good investors are looking at you, and if you don't even can handle to meet the investor, that's of course a red flag from the investor point of view. And I think again, I would like to stress one thing again. Most of you are early stage. Be aware that when you're coming up with an idea today, it's going to be hundreds of companies worldwide that are tackling the same problem. You need to be on a steeper trajectory to succeed, and the investors that you bring in needs to bring more than capital. You need to look for people that can really mentor and coach you to be on a steeper trajectory. That I really urge early stage founders when they take in their first money. Really think through who you bring in and what added value that person can give you.
And also be aware, I mean, an advisor has one real end-of-day purpose, and that's closing a deal, and they won't really care at what terms they will close it. To be, you know, generalizing here, of course, there's good advisors that thinks about the company's best, but in the end of the day, when, you know, push come to shovel, that's like their main objective, I would say. And to Hjalmar's point as well, it shows kind of weaknesses, and also if you're early stage, if you have angel investors, they will know most of the relevant investors anyway, because they've been driving their successful businesses and they have a lot of relationships. And if they don't have it directly, people they know have it. So you can actually get a pretty good head start of, but just using the network that you have.
On the process, still, is there kind of is there any guidance from you that, or do you see any difference if a founder is speaking to kind of a variety of investors, or just chooses only a few or one investor to speak to? So, Adam, you see that process quite often from different startups?
Yeah, I absolutely. From in my experience anyway, and I think these two guys probably have more to say, but early on your network is limited. So the opportunity to get out there and find sources of capital might be a little bit more restricted. But as you've grown and your network expands, and both these two have said it's important to build that network as you go along, to me there's a clear correlation between having a broad discussion about the fundraising rather than a narrow one. Both because you can find the sort of founder-investor fit, of a bigger sample to choose from, but also, like I said earlier, it can generate this buzz and a little bit of, ideally, a little bit of competitive tension in the fundraising process, where investors are feeling, wow, this is a great opportunity. A lot of other investors are very keen to make this investment. They're smart. Therefore, I don't want to lose this one.
Helmer?
I think when it comes to the process, and I think as a founder, you're always selling your company, either to customers, to hiring someone, or to investors. And I think it's so important that you really thinking through how to build that relationship and understanding that this is an ongoing thing that you do all the time. And I think a lot of mistakes done by entrepreneurs is that they think that fundraising is something that you do once and then you work and then you hit the milestone and then you fundraise again because you hit the milestone. But that's not the case. I mean, you need to preempt the whole process all the time and really fundraise when the demand is there rather than you hitting a milestone. And those things necessarily doesn't need to correlate all the time because it could be that the market is shifting and so forth. And I think since I've been in the industry since, you know, the mobile internet since '94, I've seen the change over the last 25 years. And I think it's ultra competitive today, both from a capital point of view to find the right companies, and from the entrepreneurial point of view that you have so much more competition across the board than you had 25 years ago when the market was in. But it's still the winner take most or the winner take all in most verticals. So when you start a company today, you need to really understand that you're not participating, you're there to win. And to there to win, you need to think things through across multiple rounds and how you build a team and how you actually accelerate your business. And the first 24 months is so important for a startup. What is your trajectory versus your competitors? If you are growing faster and are able to get the better people joining your company, the delta between you and the other ones is just increasing, and the investors see that, and they're going to jump on your company. Hence, you're going to be able to raise much more money for less dilution than the number 2 and number 3, and that delta is going to increase. So it's so important how you think through your start, the first 24 months, if you're here to build a winning company.
So moving on to who investors and who founders, that Johan, what are your principles in actually putting together the cap table? Kind of which investors are you looking for? Strategic, financial, what qualities they should have for you?
So very depends on the stage and the company. I think the good things with a strategic is that they probably know the industry that you operate in. They can probably be helpful with networks and even maybe drive some of your sales. They tend to be maybe less focused on valuations and willing to put in bigger tickets. Might tend to be a little bit less or more rigid when it comes to going forward as a shareholder on the cap table. It might take a little bit longer time. There's more decision tree happening in the organization, and it might not be as fast moving. Financial investors has a few benefits of being, of course, smart investors with good networks within the investor communities that will help you for future rounds, especially if it's a good brand. And they will be usually very open as long as you're a successful entrepreneur to be flexible on changes in governance structures or whatever you want to do as a founder. So it's kind of slightly different in that sense. Yeah, I think it very depends on phase and what kind of companies, but sometimes a strategic investor could make sense for you. Otherwise, as long as you can control you know what you need to do to be successful, you pretty much just need money and be let alone to execute.
Yeah. Almer, you want to
I
comment?
think it depends on case by case, but I think in general, I think you should be careful with strategic investors. And the reason why they're investing in your company is not necessarily they believe they're going to do a great return and they're 100% aligned with you in terms of building a company that has all the optionality going forward. I mean, they may invest in you to learn in terms of what you're doing because they are in the same market, and honestly potentially block their competitors to work with you, hence stopping you from getting certain customers, or even potentially being acquired of their so they're going to try to squeeze in some veto rights and blocking rights potentially in the shareholders agreement, because that's their intention with investments rather than being 100% aligned with you, actually growing your business to success. So here you have to be very careful. My view on strategics is that either you bring in all strategics and you kind of become a Switzerland in the sense of that you're actually, you are working with everyone and therefore you're neutral, or you don't have any. If you have one strategic in your cap table that is a little bit dominant, that could have big implications on your business. I mean, again, I don't know what the business you are going to do, but I should be extra careful with that. And I think from a governance point of view, you need to be very careful here.
Yeah, Hjalmar makes a very good point there.
Yeah.
And also, if they're not a competitor or a direct competitor today, who knows 5 years down the line?
Yeah.
Adam, do you see a misalignment among investors or between investors and founders often?
Yeah, I was going to say, when you do your fundraising, most of the focus, probably rightfully so, is on the financial aspects, the valuation, the amount that's going to be put in, maybe the terms of the instrument. But on the other element of a fundraising is what we broadly call the governance, which is kind of like the legal terms. And really the key issue there is control issues, basically, going forward. How many veto rights will all the investors have over the founder's business decisions? The biggest issue is who ultimately controls the board, who's calling the shots in the company. And you do sometimes see disagreement between founders and investors about how much control the investors should have. It seems self-evident, I think, to some investors that the more control, the better. The more things we can veto, the better, because we're very smart, and of course we will only veto things that are not good for the founder to be doing. But I've noticed that when you talk to some investors and you say, well, you'd like these 30 vetoes, but would you feel comfortable with the other 20 investors on your cap table having the same set of vetoes? And then they may go, oh, okay, well, that's maybe not such a good idea, because I can't always rely on them to be smart enough about what the founder should and shouldn't be doing. So finding some balance there. Like I said at the beginning, it's an ecosystem. Balance is to my mind, the watchword of the whole thing, finding balance.
And to touch upon that as a thought as well is, it's very easy to be getting in love with an investor that comes in and they charms you and they say, yeah, we love the company, we love you, we want to be supportive and so on. and you might have just started a fundraise or something, and you start just focusing on that person, and you forget about everyone else because you already found your investor. And then down, 1-2 months down the line in the negotiations and everything, the investors start to become much more aggressive in terms and control and all these kind of things. And if you haven't kind of had parallel tracks going, you have pretty much no options anymore, and you might be running out of cash and everything. So to keep parallel processes going as long as you can, and still, of course, be honest with it, because competitiveness makes usually investors more flexible as well, allows you to get the optimal outcome for you as a company, as a founder.
So what if there are already too many vetoes for one or several investors given in some rounds? At some point, kind of the new investors might want to kind of to get rid of those before they invest. So are there any tricks how to do that? Are any of the vetoes sometimes kind of trigger, terminated by certain trigger?
I think so. I think Adam can go a bit deeper. I can just start, but I think if you have a good demand for your next round, and you know that you have a little bit too much of dirty terms from earlier rounds in your shareholders agreement, one thing to do is, of course, to try to lock arms with the new investors coming in, or the new lead investor coming in, and especially if it's been extremely competitive for that investor to come in, to make sure that that investor in their term sheet puts in a lot of cleanups. So you're kind of using the new investor, and the new investor honestly care more about you, of course, as an entrepreneur, because than the earlier investors. And they have an interest, of course, to clean up the shareholders agreement as well. So you have a good alignment, especially if you have high demand for your next round, with that new lead investors, and make sure that you help that lead investor to formulate the term sheet in terms of helping you to clean up those terms. I mean, that's a kind of a tactical thing you should try to allow yourself to do. But of course, if you desperately need more money, and the situation is that you're very reliant on the existing investor to do their pro rata in the next round, to even be able to get anyone to come in and price the round, and maybe potentially even your existing investor is forced to price the next round, then you're in a weaker situation. So, but if you have the strength, try to use it to clean up earlier mistakes.
If you can get an experienced investor like Almer, has been on both sides and done this a lot, they can look at that governance and they can say, this is potentially value destroying.
Yeah.
This is not going to generate more value, and it's a real case where less is actually more. All of us having a bit less here will end up with a more fast-moving, responsive company, and then they can partner with you to say, let's restore the balance here.
Yeah, Helmer, there are many kind of founders here who, as we saw earlier, are looking for investors. What about from investor view? What are they looking in the founders? How important is the founder in the company?
Yeah. As I opened up earlier, I think it's kind of a slider from 100% the founder and the founder team when it's just an idea, to when Johan probably going to talk about more closer to the IPO, where he's very strong. It's all about your numbers, has to meet the expectations and so forth, and of course the founder is important, but then the founders should not, from an investor coming in very late, be that kind of triggering for doing the investment to start with. So I think you can say that, initially you invest in the jockey, not the horse, and then later on you're getting closer to late stage growth, is the horse you invest in. And yes, you could replace the jockey on that horse, and the horse will hopefully win anyway. I think initially it's the jockey, which is you as a founder, and the founder market fit is what you're looking for, and the ability of that founder to be on that very steep trajectory to kind of beat everyone else out of the gate in the race that you are starting, and take a leading pole position, and therefore being in that pole position, be able to attract talent, more capital, and get a flywheel, a positive flywheel. So that's what you're looking at. So I think this is the biggest mistakes a lot of investors do. They fall in love in the idea and are not thinking through, is this the founder team that will actually, when the gates are open and the race starts, will actually take the lead and actually be able to execute this idea by attracting that talent and be able to execute with that talent idea, and then later on attract more capital. This is a classic mistake, and most founders are talking about the idea, not enough about making sure they come through as a solid founder that has the obsessiveness and the grit to actually, not just come out of the gate, but actually then come on and actually win the race as well. So I think this is my advice, is like really think through, if you're a sole founder, how do you build your team very early? And honestly, I think the best founder are groups of founders. We have a very strong visionary sales and marketing founder that really can expand the business and lead the business, and then a very strong founder, co-founder, tech person team around that sales visionary marketing person that really can sell and actually, and then making sure that the combination of this has the execution power. Super important.
So there's a due diligence on founders. Johan, are you doing a due diligence on investors? Or should there be?
Well, you should, yes, of course. And I think we are in a situation now where there's a lot of entrepreneurs and founders out there that's willing to share their knowledge and experience with investors. And before you bring someone in, it's kind of, you don't bring whoever into your house. And this is someone, to Hjalmar's point, you will live with for a very long time, hopefully forever, perpetuity as a good investor and backer. So you need to make sure that you don't bring in someone that, first of all, doesn't align themselves and their values with your values, and also when and if you hit that bump, probably when, they will not start acting aggressively to protect themselves, but rather constructively thinking about how can we get out of this and how can we continue to focus on growth. With that said, though, for you to be able to choose and pick and cherry pick the best investors and so to speak, kind of pick your team, you need to be very competitive in your processes, and you need to always build those relationships with investors. And of course, in the end, it is what you achieve as a founder and as a company that will really define whether you have the strength or the weakness in those processes. So yes, you should do due diligence, and the absolutely easiest and best ways to do it is to call people in companies where those investors are invested, and if you can, in companies that hasn't been performing that well with that investor on the board, because all investors are going to be super happy and do exactly what you say as long as you continue to double up year over year, because they just see their money, and their new houses and whatever, and they don't want to mess with you. But as soon as you hit the bump, that's where you see the true identities of founders or of investors.
Yeah. I think you have two kind of investors. You have the ones who really are looking at the opportunity and how you can win together, and they're much more happy to take risk, because they know that out of 10 investments, it doesn't matter if 7 or even 8 of them are becoming 0, because you can only lose 1x. So if you're really looking as a risk investor that you can do 10x or 20x or maybe 100x, you don't really care if you can lose 1x. But then you have the other kind of sets of investors that are more in the camp of what's the downside protection I get. They're more focused on the pref stacks and say, if things doesn't go well, how do I get back my money? And of course, when you hit the speed bump, those investors get very nervous, because they're more thinking about the downside protection rather than the upside opportunity. So I think if you're really there to build a global success story and you have that drive that so many people in this country has and you've been so successful with, I mean, if you're looking for that, you need to have investors understand that the highest likelihood is actually 1x write-off here. But we don't care about that. We care about your passion of building an amazing company. And we know if you do that well and I can support you, it could be a 100x return for us. And across 50 investments, that's what you should look for, I think, if you're an early stage investor and teaming up with great entrepreneurs, is to share that risk reward. And then when the time goes, you need to understand that entrepreneur should not sell too early. I think that's a common theme we have in Europe over the past decades, that we have a tendency to sell too early. I think here we actually have a market that works much better now, with that entrepreneurs can sell some secondaries to offload and actually pay back that top mortgage they have on their house or apartment, and actually be able to kind of make sure that they can feed the family, so to speak, as the breadwinner. And that, when I was an entrepreneur in the 90s, if I would even mention to an investor I would like to sell some of my shares, they would get super nervous. They would say, oh, this is really bad. And most investors back in the 90s and early 2000s were like, oh, the company's worth $100 million, time to sell. I think you need to get investors who really want to build a global winner, that are aligned with you in the longer term vision, and are scared for, that it could be a failure, and learn from that failure. And sometimes when we invest in entrepreneurs, we say, maybe this entrepreneur fails with this company, and we would be happy to back the entrepreneur's next company based on the learning from the first one. So sometimes we even know that this may be not the company the entrepreneur will win with. It could be maybe just a training company, and we're willing to take that risk and hopefully tag along on that entrepreneur's next journey.
Unfortunately, we have run out of time, but I do have one more question to you, Helmer. You mentioned about the equity platform, Mother Brain.
Yeah.
What is it?
Yeah, one of the investment theses we have at EQT is to be able to actually find the best companies. We need to assemble a lot of data, and we have a neural network that helps us to score all companies. We have over 500,000 companies that we collect in data, public data, and we're buying some data as well for that. And all these companies are getting ultimate scores that are being updated on a continuously basis.
Yeah. So, and yesterday you looked you looked at various companies, and you discovered that one of the companies scored the most. What was the company?
The highest scoring company in Northern Europe actually was Bolt. Over the last 18 months, so they had the high score number for us here in this region. So, of course, it's a pity and it said very clearly it was out of scope for EQT Ventures, which I now need to go back and change. Where we stop investing, because we actually put that a bit too low. But Bolt is doing great. We know that for sure. We're following that company by a lot of others as well. But yeah, a pity that we didn't invest in Bolt when you joined, or earlier than that, for obvious reasons.
On that note, thank you, and let's give a big applause to the experienced gentleman here.